you drill into the commercial segment, a lot of activity in the commercial segment of the solar market happens in the multi-million-dollar kind of deal size scale. And just to kind of put that into perspective in the context of the TAM, the total addressable market, $1 to $2 million system generally requires about 100,000 square feet of roof space.
What happens when an engineering, entrepreneurship, and environmental commitment collide? In this episode, Scaling Profit with Purpose, Clean Energy Meets Capital Strategy, we unpack how commercial solar is becoming one of the smartest plays for high net worth investors seeking aligned returns. Hello, and I am Dr. Alan Lomax, founder of Steve Talker Capital and your host on Streams to Impact. This podcast is where high-income earners become high-impact investors using secure, passive strategies that turn wealth into freedom and freedom into legacy. We provide access to high-yielding private placements. If you're curious as to how you can participate, schedule a complimentary discovery call today, and we'll explore your options. Well, let's dive into today's episode. You are about to meet Dave Riess, a founder who's merged deep engineering with high-tech entrepreneurship. And under his leadership, Wunder has become a major force in solar investing, managing over $1 billion in transactions that drive change and returns for investors. So welcome, Dave. We're so happy to have you with us here today. So if you will just tell us a little bit about what led you into Wunder from its founding to over $1 billion in transactions.
Awesome. Thanks for having me. Yeah, so there's a fairly circuitous backstory to Wunder, as I guess tends to be the case. But it really all originates from a quarter life crisis that I had, realizing that, I'm going to spend a lot of time in my career working on really hard problems. And so I may as well work on the most important problems. As you noted, my background's in electrical engineering. As I sort of had that realization, I started to think hard about what are the hardest problems, the most important problems to be solving. And at that time, and still today, at the very top of that list is energy. And so as I kind of delved deeply into the world of energy, it became very clear to me that there's a massive opportunity in what we refer to domestically as energy transition that's happening within the United States. And if you look at what's happening within the energy transition, I think it's a pretty easy case to make that solar is the most exciting component of that. You can look at sort of just the growth rate across that segment broadly. And you can look at the various different opportunities that exist within that segment. And that's ultimately where we sort of settled on commercial as one of the most underpenetrated, underserved, and underaddressed segments of that market. It turns out that the reasons why there is so much opportunity are generally, in commercial specifically, are generally driven by the fact that the problems that sort of constrain growth in that market have historically been rather challenging. And so we set out about 11 years to really tackle those things, and have evolved the company meaningfully as we've addressed sort of a broader and broader cut of challenges that have historically kept growth within the commercial segment at bay.
Well, thanks for giving us that background, Dave. So you had mentioned that there have been a number of different problems that have faced the solar industry, and that a lot of that really was related to the commercial aspects of that. So what were some of those core problems that you have been attempting to solve over the last 11 years? And how has the vision evolved over the last 11 years? I know there's been huge changes in technology, and I know that that's affecting not just solar, but everything in our lives. So what were some of the initial problems, and how has it evolved?
So there's kind of a few categories of headwinds that the commercial market has historically faced. And I think maybe to understand them, it's helpful to think about sort of what the full breadth of the renewable energy or the solar market looks like. When you take that zoomed out perspective, you see that there's basically three segments that we divide things up into. There's, on the one end, residential, which is what you think it is. There's utility scale, which is giant installations out in the desert, capex of $100 million and up. And then in between residential, nominal transaction size, maybe $10,000 to $15,000. And these $100 million systems is what we call the commercial segment, which is, strictly speaking, for a long time has been defined as non-residential and not utility scale. So it's a pretty big cut. And so if you look at what happens within commercial, you see a couple of dynamics that have historically caused friction. So number one is how capital is allocated. So in residential, it's allocated generally on the basis of FICO. Underwriting is essentially uses FICO as a risk proxy, as does a lot of consumer finance. And then at the utility scale, it's project finance. If you're doing a $100 million transaction or a $400 million transaction, you can afford bespoke underwriting, bespoke legal structuring, and so on and so forth. Mm-hmm. And then when you look at the commercial segment, basically you don't have FICO to lean on for kind of a highly homogeneous, kind of commoditized form of risk evaluation. But in a lot of cases, you really don't have sort of the scale of traditional project finance to absorb the transaction costs of bespoke underwriting. And so you kind of end up, at least historically, in a little bit of a no man's land. Mm-hmm. So that's sort of, access to capital is one segment. I think the other thing that I would point to is two other things I would point to. Number one is cost structure. So it's a really similar dynamic. But in general, if you drill into the commercial segment, a lot of activity in the commercial segment of the solar market happens in the multi-million-dollar kind of deal size scale. Think like $2, $3, $5, $10 million of capex. Mm-hmm. And just to kind of put that into perspective in the context of the TAM, the total addressable market, a $1 million system or a $1 to $2 million system generally requires about 100,000 square feet of roof space. So you need about 100,000 square foot floor plate for a building in order to justify about $1 million or $1 to $2 million of capex for deployment of that system. And overwhelmingly, if you look at sort of the U.S. building stock commercial setting that we operate in, 98% of the commercial building stock has a footprint that's smaller than 100,000 square feet. And the whole market skews kind of, at least by our industry standards, towards the small end of that continuum, which means that overwhelmingly the opportunities in this market are sub-$1 million capex. That's kind of the conclusion. And so when it comes to sort of operational excellence, operational efficiency, cost structure, it's really, really important in this market, if you want to achieve any kind of consequential scale, to be able to operate in a way that enables you to profitably serve that sub-$1 million capex sort of kind of segment, and that's something that historically has been rather tricky. So that's so access to capital, controlling deal cost, and the final piece, which I would actually put at the top of the list in terms of its importance, is really just the quality of the customer experience. It's like any product. Energy is no different. Rooftop or on-premise energy, solar, no different. Our customer in this context is a commercial real estate owner. And so I think one of the things that our market has done very poorly historically has been sort of constituting these sorts of transactions in a way that commercial real estate owners are excited to say yes to. And so that's one of the things that we're really focused on, is basically delivering these on-premise energy assets in a way that is low pain, low risk, on time. We seek to under promise and over deliver. And what we really want to do is create a deployment experience for our commercial real estate owners that enables them to do 1, 3, 5 initial projects with us, and then be excited about saying yes to the next 50, the next 100, because most commercial real estate is owned institutionally. And so those are kind of like the three ways that I would segment the challenges. There's other things to point to, but broadly speaking, I think this customer experience is sort of the umbrella that everything sits within. And then the other factors, the cost structure with which you execute and your ability to access capital and flow capital into those opportunities, are supporting actors in being able to ultimately deliver.
I want to come back to this, the commercial real estate owners and the dilemma of trying to interest them and to please them. But before we go to that, most of our viewers and listeners are high income, high net worth individuals and looking for investment opportunities. And so I want to come back to this aspect of capital and the challenges you are facing in conjunction with uh, attaining that capital, and how is it that private individuals can can help in that, as well as, of course, what kind of returns could they be expecting by joining in that as private investors?
Yeah. So this is something that has changed really a lot over the years. So when we established the business, we were primarily focused on kind of the capital allocation component of this puzzle. And in fact, when we established a business, it was a very different business. It was in a lot of ways much more narrowly scoped. We were focused on essentially underwriting and financing projects, third-party projects in the space. Fast forward to today, we are now kind of a front to back, essentially a developer where we transact with a commercial real estate owner, and we do everything from manage the commercial real estate owner relationship and that sale all the way through design, construction, permitting, operations, and so on. But anyway, if you rewind the clock to where we started, when really access to capital was a very acute problem, and it was a meaningful constraint on the market. One of the things that we very quickly realized, kind of going again sort of to this observation of where is the TAM, where is the market today, how do we close the gap between those two things? Because we realized that essentially, for all intents and purposes, the majority of projects that were getting done in the commercial space were getting done on the basis of investment grade credit. So when I opened by saying that there's no sort of FICO equivalent in the commercial segment, it's sort of there's an exception to that, which is investment grade offtake. And so if you have a project that you're deploying capital into, and the revenue stream, so in our market, revenue comes from the sale of electrons in some way, shape, or form. And so if that revenue stream is backed up by an investment grade credit, think like a corporate, like a Walmart or a Target or something like Home Depot, something along those lines. Then generically there was financing available for those sorts of credits. However, those investment grade credits represent a perishingly small proportion of the total opportunity set that exists within commercial. And so that was really the initial innovation that established the business, was what we call internally our solar first underwriting strategy. And our solar first underwriting strategy is ultimately, there's some nuance to it, but it's fundamentally fairly simple. What we really focus on doing is deploying high quality energy assets on top of buildings that are likely to remain occupied for long periods of time in markets where the capital cost of deploying that energy asset enables us to undercut the utility. So that's kind of the tenets of a successful investment from our standpoint, is that certainty of a customer for the energy, the certainty of energy production, which is a function of the quality of the underlying system, and then the certainty of a sort of relatively competitive value proposition relative specifically to the next best option, which is in basically all cases is the utility. And so if we have those kind of tenants satisfied, we generally see really high payment performance, and over $500 million of financing, that really proved to be the case. And that's really where we kind of cut our teeth scaling that up. So to get to your question, I think there are I guess kind of going back to the establishment of the business, that was very novel, right, at that time. And I should say that underwriting methodology, the idea that we were not exclusively financing projects based on investment grade kind of energy purchaser credit ratings. And so we had a chicken and egg problem, right? We had a novel underwriting methodology, and you can't really prove a novel underwriting methodology until you have capital. And of course, you can't really form capital from, certainly at least Wall Street, until you've got a track record. So the way that we solved that is we actually built a crowdfunding platform. So if you'd asked me this question back in 2016 through kind of 2019 or 20, I would have said, well, you go to wondercapital.com and you can invest there. We no longer do that. And just, I guess maybe to connect those dots, that was essentially maybe it's obvious, but that was the solution to our chicken and egg problem, because individual accredited investors have an ability and a sort of agency to think in a way that's different from professional investors, where a professional investor, is very much generically indexed on where precedent is in the market, and if something goes sideways, are they going to lose their job? That kind of thing, whether it's explicit or implicit, that's part of the calculus. With an individual credit investor, I think there's a much better formed ability to think from first principles, think from fundamentals, and then also, a lot of cases in the early days, our accredited investors were highly impact motivated, where they're like, okay, well, these returns look attractive, but I'm fundamentally investing here because I believe in the returns, but also the use of proceeds. So in any case, if you fast forward to today, I think the landscape looks a little bit different. Our capital now comes from Blackstone. It's now institutional. We form capital at significant scale, and it's relatively very competitively priced relative to where we were a decade ago, and so the yields have kind of compressed. There's still a little bit of a premium that's commanded in the commercial segment, and so I think the opportunities there are absolutely still opportunities to invest in this space. I think they're a little bit more tricky to source. I think that there are a lot of sort of local actors who are forming capital at scale that's conducive to sort of relatively smaller, single-digit $1 million check sizes, that sort of thing. But again, I can't make any promises about how other actors in this space underwrite. I think our underwriting, not no ego about this, but I think our underwriting is unparalleled in this market, and not for nothing, because we've done $500 million of this underwrite. So we've got a lot of reputations in the space. We've got a lot of experience doing this stuff.
Yeah, well, thank you for clarifying that. Let's move back to the commercial real estate investors and bringing the product to them. The thing that I have always seen standing in the way of commercial property owners going with alternative forms of energy is because oftentimes it is the tenants who are paying the utilities, and there just is no incentive from that perspective for owners to put forth any capital in shifting that situation. Have you found that to be the case, or?
So I think I would just modify one thing there, which is that I certainly agree that there's, in most cases, not a lot of incentive for commercial real estate owners to deploy the capital. However, there is an incentive for them to undertake these transactions. There's actually a few incentives. So number one is that there's a few different sort of forms that our transactions take. There's a few different sort of structures we use, but overwhelmingly, what we're doing is we're approaching a commercial real estate owner with a roof lease proposition, where the value proposition to the commercial real estate owner is property level NOI. So we say, hey, commercial real estate owner, we can help you generate additional NOI for your property. And we do that by paying you a roof lease payment for the rights to locate energy equipment on your rooftop. And then we take full responsibility for monetizing the electricity that comes from that array. So it is accurate to say that most tenants are responsible for energy costs. But I also think that we've arrived at a scenario where there very much is a real incentive. I think the ancillary incentive here, which is I think present today in 2025, but is absolutely going to become much more of a factor over the next 5 to 10 years, is the tenant motivation, the tenant benefit. So the presence of an energy asset on a rooftop provides what you can think of functionally as a physical hedge against rising electricity rates. And so there's a lot of businesses, that comprise, the domestic economy, where electricity isn't something that operators are thinking a whole lot about. But I think it's important to recognize that, over the last 20 plus years in the United States, energy demand, and in particular electricity demand, has been rather flat. And that's changed over the last couple, 3 or 4 years. We're starting to see electricity demand increase again at a pretty astonishing clip. And that's driven by, everybody wants to point to data centers. And that's a big factor. That's sort of in the zip code of maybe a quarter of that upward pressure on demand. But the rest of that, the 75% remaining, is a function of fleet electrification. It's a function of building system electrification. It's a function of reshoring. And so in general, we really divested of manufacturing in kind of starting in the late 90s. And I think that trend is reversing in a big way. And our energy infrastructure is just not set up to build at a meaningful pace more generation. So all that is to say, from a commercial real estate owner's standpoint, tenants are going to start to feel that. I mean, we're going to see in markets unprecedented levels of electricity rate escalation. We're talking, there's going to be cases where we're going to see north of 30% annual increases. That's not going to be across the board. It's going to hit the market in an inconsistent way. But in any case, I think the reality is that there are going to be a large number of markets, especially markets that already have elevated electricity costs, where tenants are going to start to make property selection decisions, at least in part informed by what the energy reality looks like on the ground in those specific locations. And so we find that our commercial real estate owners are very interested in staying competitive in a landscape. Lease up is very important to all of these guys. And so anyway, I think that there's sort of ancillary benefits there, and our objective, as much as we are a mission-driven business that is focused on scaling and accelerating the pace at which we're deploying renewable energy domestically, we realize full well that the most potent way for us to do that is by harnessing the free market, and really by building sort of a capitalism-driven engine. And what that means is delivering a value proposition to the commercial real estate owner where items 1, 2, 3, and 4 are economic, and maybe item 5 is environmental, but it's sort of a supporting actor, if anything.
Well, you mentioned environmental, and of course, one of the driving forces for solar has always been that aspect of the environmental issues, and yet the solar industry, wind industry, and so on and so forth are really falling really short in terms of really making that environmental impact that was envisioned, because the components, building those components is anything but environmentally friendly. And of course, they always have to be continuously replaced. And in conjunction with that, the oil and gas consumption, as solar has started coming on, is not really decreasing. So it's not really making the environmental impact that was envisioned. So being in the industry there, what are you as industry leaders, how are you looking at that issue? What kind of mitigations are you looking towards to make this fulfill the dream that was there when we started down this road?
So I mean, I would go back to kind of the thread I was just pulling on, which is that my fundamental belief is that the way that we get to the promised land here is by harnessing the power of capitalism and by harnessing the power of free markets, and through high quality execution and operational excellence. That's how we get costs down, and that's how we get to scale. I would challenge the premise that we haven't made a lot of progress on this. I think this is a big market. I think one of the things that as an investor, I think it's oftentimes a little bit difficult to appreciate the sheer scale of the energy market, and there's very few markets that comprise the proportion of GDP that energy consumption does. And so I think that's both sort of a justification for why it's something that's not happening overnight, but it's also, maybe more importantly, a justification for why it's so important to have the tenants be rooted in capitalism rather than federal handouts or state incentives or that sort of thing. I really want this technology to perform and compete on its own merits. As far as the kind of full life cycle impact goes, I think it unassailably, the new generation that is coming onto the grid, despite all of the headwinds that we face, is overwhelmingly renewable. 90% of all new generation in 2024 was wind and solar, and dominated by solar. And especially, in the wake of One Big Beautiful Bill, I think we're going to continue to see solar take even more market share of that renewable generation. And I think that we're going to continue to see the share of new generation being deployed on the grid annually be just absolutely dominated by renewables. It just and this really boils down to the fact that it makes more economic sense. It's really powerful to not have input costs into your generation. We don't pay for photons. We get those photons from the sun for free,
Mm-hmm.
and we convert them into we magically convert them into value, right? And so, um, I think we're still. I don't want to say we're early days. I think the market's getting to a place of higher levels of maturity, but the world, whether you're talking about the Energy Information Administration or you're talking about the kind of international agencies, has always wildly underestimated the rate at which the deployment of these technologies will grow. And I think we have really yet to see kind of like the main act, if you will. I think that the rate at which we're going to start to see this equipment being deployed over the next couple of decades is going to be pretty phenomenal, and that's ultimately going to be driven by the supply and demand dynamics. We've got increasing demand, we don't have expanding supply, and so that's going to put upward pressure on price, and that's going to be all the tailwind we need from a kind of free market standpoint to really drive adoption. And then as far as the cradle to grave, perspective, I think it's some form of the argument that like EVs are not clean because they consume energy that's generated in centralized generation facilities, and I just fully reject that argument because we can't have progress to a better tomorrow without some stepwise changes. There's just no feasible way for us to kind of overturn all of our incumbent infrastructure in one fell swoop, and so maybe we have a different opportunity when we colonize Mars. We can build these systems from the ground up to be, sustainable from the jump. But that's just not the sort of reality of where we exist. And so fundamentally, I think fleet electrification is very important. And again, it's the same thing where I don't know. I'm sure you have listeners who own EVs. They're objectively better vehicles. Like there's no two ways about it. They're higher performance on every single dimension, with the one exception being range, which is quickly becoming a thing of the past. But I mean, if you just look at the maintenance on these
Mm-hmm.
things, if you look at the performance, if you look at the number of moving parts, there's just so many ways in which electric vehicles are just objectively superior technology. And the same is true for distributed and renewable generation. Historically, the caveat has been cost, and that's really no longer the case in a lot of markets.
Well, in our closing question here, Dave, looking ahead, what do you see the trends in terms of clean and renewable infrastructure? Uh, what do you find most exciting about looking ahead?
I think most exciting to me is really just the scale of the opportunity that remains before us. I mean, part of it, I think, to your point, is it's we sort of I think a lot of people in this space wish we could have gotten to greater levels of scale more quickly. But I think it's also important to take stock of the fact that the growth within the market has been pretty consistently pretty remarkable. And so for me specifically, if you look at those growth trends, what I'm specifically most excited about is very much the commercial market. And that's because that has actually been an exception to the growth story that exists within solar. Over the last 2 decades, we've seen very high levels of sustained growth within the utility scale segment, and we've seen very high levels of sustained growth within the residential segment. And the CAGR, like the 5 or 10 year CAGR on commercial, is generally hovers inside of 1 point. It's a very, very slow. We see something in the zone of $2 to $3 billion a year of new infrastructure being deployed in the commercial segment annually, and the reason that I don't think we've seen major sort of year-on-year deployment escalation has been because of the confluence of some of these challenges that really keep that growth at bay. And that's really what I'm excited about solving, because of the extent to which deploying technology in the segment can actually move the needle for the cost of power that's delivered to the plug in a commercial setting. And so that's there's a lot of work left to be done, and there's going to be a lot of strong returns generated in this market, and it's very much not as though the train has left the station. There's still plenty of opportunities to find ways to deploy capital against those themes and against those trends.
Well, Dave, wonderful having you here today. Thank you for sharing your wisdom and knowledge in regards to the prospects of alternative energies and glad to hear that it is progressing to the degree that it is. I look forward to that becoming even accelerated, as I know that you do as well. So, enlightened investors, thank you so much for being with us today. We're always honored and privileged to have you with us. Thank you for taking time out of your day to be with us. If you've enjoyed today's conversation, please take a moment to like, share, and subscribe. And until we meet again, live abundantly. We'll see you in the next episode.
Thank you for tuning into Streams to Impact, brought to you by Steed Talker Capital, a company empowering passionate professionals like you to develop multiple streams of passive income built on solid passive real estate investments. As a significant part of our endeavors to make a cosmic and meaningful impact for this world, Steed Talker Capital contributes significant portions of our profits to activities and organizations committed to better understanding the equine. These endeavors attempt to enhance the treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures great and small flourish abundantly. If you are ready to learn how our passive investors have earned an average 33% annual return on their investments, schedule your complimentary passive income to Prideful Impact consultation. Obviously, we cannot continue indefinitely to offer these valuable consultations for free, so grab your passive income to Prideful Impact consultation while you still can. Go to steedtalker.com/passive